Hi everyone! Welcome back to Practical Pam. As you may know, our last lesson was on home economics. How did it feel to be in charge of the household chores? Did the 7-day menu help you make some delicious meals and save a little money? Are you going to keep using the chore chart at home to keep track of everyone's tasks? Today, we're going to be talking about taxes. Make sure you have your Taxes 101 handout printed out so you can follow along with Practical Pam. Remember, the link to the handout should be below the video in the description. If you're new here, we want to say welcome. Practical Pam puts out a new video every week on helpful topics like budgeting, government, and home economics. Through our lessons, we answer common queries for the growing mind, provide worksheets to help retain our lessons, and challenge our viewers with Practical Pam's Project of the Week. Before watching this video, I would recommend watching and working through our Government 101 video first to gain some knowledge about how government is structured, since that information will come in handy today. Click the link in the description to watch Practical Pam's Government 101 video before coming back to this one. Taxes are a fact of life for almost every person around the world. It's a concept almost as old as currency itself. But what are taxes? What do we use them for? Why are taxes such a universal fact of life across time and culture? Tax is defined as a compulsory contribution, or mandatory payment, to state revenue, levied by a government on workers' income and business profits, or added to the cost of some goods, services, and transactions. When money is changing hands in an official capacity, like for buying groceries, purchasing movie tickets, ordering items online, or receiving a paycheck, there is almost always a tax applied to the transaction. In general, taxes are made in percentages, so a portion of a transaction will go to the taxes. For example, if something is taxed at 11%, taxes would add 11% more money to the total amount. If you want to purchase $100 worth of items, you would pay a total of $111. If you want to purchase $200 worth of items, you would pay $222. The $11 from the first amount and the $22 would be collected for taxes. Even though they're different amounts, the tax rate, 11%, is the same. So why do governments need to collect taxes? As we've discussed before, a government is both the structure created to run a society and the people whose job it is to facilitate that structure. Everything a government does costs money. But that doesn't mean that the government is the same as a business. When you run a restaurant, you charge people for the food they order, and that's how you're able to stay in business. But for the government, rather than charging people a set amount of money or making them purchase their services individually, they instead collect little amounts of money from every citizen or person who lives in their country through taxes. Can you imagine a firefighter handing you a bill after they save your house? Or the mayor knocking on your door collecting your family share of money for a festival? You can easily see why taxes have been the method used by governments for thousands of years to maintain their structure and the welfare of its citizens. Now, let's take a look at how taxes are applied to our everyday lives. First, let's look at sales tax. Sales tax, or value-added tax, is a tax applied to the items we buy. These taxes are collected by the businesses we purchase from, but the value of that tax is passed on to the government. Businesses must keep detailed records of everything they sell so that they can keep track of how much money they need to give to the government. A company that charges a sales tax is not allowed to keep it for themselves. That wouldn't be fair at all. Sales tax is applied either to the category of items or to specific items. For instance, taxes on a car you buy are the same no matter the make or model. However, certain items can be singled out for more or less tax. Groceries tend to be taxed lower than prepared foods, or food that was turned into what would more likely be considered a meal, as opposed to ingredients. For example, in New York City, people love to buy bagels for breakfast. But if you ask the person behind the counter to toast the bagel and add on some cream cheese, they're going to have to charge you more tax. The bagel is considered groceries. The toasted bagel with schmear, as they call it, is considered a prepared food. In the United States, there is no federal sales tax, which means that state and local governments get to determine how much tax they charge for certain items or categories of items. If a state is famous for a certain item, like Washington State seafood or Maine wild blueberries, they will sometimes add a special tax just for this item. Often that extra money is used directly for that industry, given by the government back to the people who work in that industry. So not only do state and local governments have control over the taxes they impose, but also on how the money is spent. In Canada, there is a 5% sales tax called the GST, or Goods and Services Tax. Many categories of goods and services do not have a GST tax, such as basic groceries, legal aid, prescription drugs or medical devices, and local and municipal transportation on buses and ferries. Some provinces do have separate sales taxes or combine their sales taxes with the GST to create what's called the HST, or the harmonious sales tax. Now let's look at income tax. Income tax is a tax that both federal and state or provincial governments impose on income generated by businesses and individuals who live and work within their country. Every person and business is required by law to file their taxes yearly. That means they have to fill out a form and turn it into the government using information they have gathered over the course of the year. Employers can take out a variable portion of the estimated taxes a person is supposed to pay out of each paycheck for the government to hold on to. Some people choose to have the maximum amount taken out. Others want to have less money taken out each paycheck so that they have a little bit more money during the year. Once taxes are filed and other factors are assessed that affect income tax, a person either owes more money than what has already been taken out of their paycheck or had more money taken out than they actually owe. This money is called a tax return. Basically, the government was just holding the money until all the actual numbers had been calculated, and then they give it back. Some people like receiving a tax return since it's a sum of money given at once. Other people prefer to have as small a return as possible. If the government is just holding your money and not doing anything with it, you might want it for yourself so you can spend it or save it without waiting for months to get it back. Once you get your first job, it's up to you to decide how you want your taxes to be held. If you already have a savings account, like we discussed in Budgeting 101, you might not want a tax return, since 10% of the money you make is being set aside for your savings already, meaning less money going into your budget. Being proactive and asking questions is very important when you start out in the workforce. Often, your employer, your local bank, or a family accountant can assist you in explaining more difficult concepts and giving you good advice. In both the United States and Canada, income tax is progressive. That is, the rate goes up based on how much money you make. However, this does not apply to a person's entire salary. That wouldn't be fair. Instead, income is broken up into brackets. Let's look at the Canadian federal tax bracket for this year, 2020, to explain this concept. As you can see, anyone who makes between $1 and $48,535 should pay 15% of their income to taxes. The next bracket is people who make between $48,535 up to $97,069. They pay 20.5%. However, they don't pay that amount on their entire income. For example, if someone makes $50,000 a year, they still only pay 15% of $48,535. That leaves $1,465. That is taxed 20.5%. They do it this way because in general, most people pay the same amount for certain things. We only need to pay so much money to be well fed or properly housed, have a working car, so on. Therefore, there's a certain amount of money that everyone needs to survive and live without hardship. If you make a lot of money, you don't necessarily need to have an expensive fancy car or a giant mansion, so on. These things are nice, and they exist because people want them and can pay for them. But a person who makes a lot of money can still live and survive and live well, just like a person who makes less. Basically, the cost of living for someone who makes a lot of money and someone who doesn't is relatively the same. We don't charge people who make a lot of money more on everything they make, but we do charge them more on the parts of their salary that are higher. This is a way to keep our taxes fair and relative. It's also good for people who make just above a certain amount of money in a particular bracket. Imagine paying thousands more in taxes just because your annual salary goes up by a couple $100s. That wouldn't be fair either. Income taxes need to be filed at the same time every year. In the United States, April 15th is the deadline, and in Canada, it is April 30th. We pay taxes by year, so on April 15th, 2020, or April 30th, 2020, you would file your taxes for January 1st, 2019 through December 31st, 2019. This amount of time in between the end of December and April gives people, businesses, and employers time to gather their records so that their forms will be accurate. Many people file before the deadline, especially people expecting a tax return, or people who don't have a lot of information to put on their forms. This year, due to the disruption of COVID-19, both the United States and Canadian governments have extended the official deadline back to July 15th in the United States and June 1st in Canada. This was mainly done to help people who may owe extra taxes than what is being taken out of their paychecks and have had their current income affected by COVID-19. The governments of the US and Canada want to do what they can to make sure people aren't being asked to pay money that they currently need, since their income has been reduced. Taxes are necessary for a functioning government, but a government can't function if its citizens are in trouble. Taxes are a fascinating and sometimes very complicated subject. I hope that this lesson has laid out the basics for you. If you have additional questions, you can send them to me at practicalpam@bestbrains.com. We might cover them in a later video. Remember to subscribe to the Best Brains YouTube channel if you haven't already, and check bestbrains.com/interactive-workbook for a free downloadable workbook full of fun activities. I've been Practical Pam, and we'll see you next week. Bye! Goodbye! Bye!